I'm going to start with a little video to create some inspiration, to create some activation. Angela, I really like your background. We have started to get clients actually out of California, specifically San Francisco. Our world is growing, which means your world will grow for so long as we all remain focused on one thing only, and that's why we do what we do. And in order to introduce that, I'm going to move to the next slide to do the heavy lifting for me. We just need to let the buffering have its place and space. It's an enormous file that happens over a very few short seconds. I love it so much, I'm going to play it again. Wealth creation. It's so interesting. I have to write a piece on wealth creation. What is wealth? And arguably there are four types of wealth. There's spiritual wealth, there's physical wealth, there's mental wealth, and then there is financial wealth. And it's been quite interesting because philosophically, there are lots of discussions around what wealth means. Does it mean that you've got friends and family that love you and care for you? Does it mean that you feel connected? And do you feel centered in your daily life? I want to talk about wealth from the position of why we do what we do with regard to our businesses. And in that light, wealth really has three elements to it. The first element is that wealth means through our businesses, we need to make money. Because if you don't make money, the second element of wealth creation falls away. And that is, we then need to grow our money. And then on top of it, those two elements mean nothing if we cannot realize our money into capital. And wealth is really not well understood right around the world. Because I've had this discussion with many, many business owners. The mere fact that we have all decided, some of us out of opportunity, maybe 2 or 3% of us, but most of us out of necessity, that we are going to create a business in order to secure our economy and generate income to look after ourselves, our families, to support our teams, our staff, our employees, to be of value to our customers, our suppliers. We have to ask the question, why do we do what we do? And where do we want to go to? And I want to talk about that today in relation to how we fund the creation of wealth within our client base. So there's three strategies that you should be looking at now in your businesses. And depending on your circumstances, depending on your age, depending on the type of business you're in, depending on where you are at with your business, any one of them validates the opportunity for turn your business into your greatest wealth generating asset. The first one is, and let's just have a quick show of hands, who intends to scale grow and dominate the sector that they're in by doing what they're doing. So Joshna, you up for it? Mpo, you up for it? Fatima, you up for it? 1, 2, 3. The 3 elements of wealth. You up for it? Angela, you up for it? Okay, that's one strategy. And there's a very particular approach to doing that and achieving that. The next strategy is one where you are looking to, in the next 3 to 5 to 7 years, grow your business, deepen your value with a view to sell and exit your business for a capital gain. Who's on that journey? Where are you with regard to that? Okay, so Tanya from Cape Town Wine Hub, Tumi, right. Seth, we're going on that route. So it's interesting because what I'm sharing with you here are 5 to 7 year strategies. 5 to 7 year strategies. And then lastly, some of you are saying, I need to grow and exit my business, but not through a sale to a third party, but either to family or to my team, my junior leadership team, my young management team that are standing and sitting and pushing behind me. Who's on that journey? Okay. So folks, it's interesting because you can see in many ways, we spend 10, 20, 30 years building our businesses, but we don't think about our exit strategies. If you're looking to scale, grow, and dominate over the next 7 years, then what you're looking to do from that position is 7 years on, shift your strategy to grow, deepen value, and exit through a sale to a third-party buyer, like a corporate business that wants to acquire you, or an IPO on the Johannesburg Stock Exchange. If you can't find that as an exit, you're going to find it through succession. So 3 wealth creation strategies that we should all be thinking about in our businesses. Let's just understand how to turn the value we create in our businesses into wealth. And I've shared this idea with many of you before. If you buy a share on the Johannesburg Stock Exchange, let's say for 1,000 Rand, you need 3 things to happen to turn that share into a wealth creating asset for yourself. The first thing you want is you want to know that that share, if you sell it 5 years later, the share you bought for 1,000 Rand, you can hopefully sell for 2,000 Rand. And that's called capital value. That's capital growth. The next thing is over the 5-year period that you hold the share, you want the share to give you dividends. The extra cash that that business makes, that provides it to its shareholders and investors by way of dividends. Let's say 200 Rand a month for 5 years. So you've got income growth through dividends, that's cash coming out every month and every year. And then you've got capital growth at the end of the game when you sell that share. Excuse me. Now, what's important is that to sell the share needs to be sellable and buyable. Because who's going to buy it? Mpo made that investment. Asanda's going to buy it. What does Asanda want to see when he buys the share that Mpo's selling? He wants to see for the next 5 years ahead, he can get income growth, he can get capital growth, and when he chooses to sell it 5 years on, Pippa will see value in buying it because she can then see in the 5 years ahead, income growth, capital growth, and the fact is it's got to be tradable. Most of us, and we go through good times and bad times, rough times and easier times, are actually good at getting our act together to build a business that generates income. By far the majority of us, globally, are terrible at turning an income-generating business or job into a capital-growing asset. In fact, in the United States, which is a very, very vibrant market, About 95% of businesses started, despite the fact that they generated good income, are not sellable at the end of the day. They close. In Australia, which is a very mature, sophisticated market, with good government policies, proper rules and regulations that support the establishment and creation of a competitive environment for business, 97.2%. Guys, I'm telling you now, in the United Kingdom, which is one of the oldest established, organized, structured economies, it's closer to 98.2%. Globally, we're not good at it. So what we do in working with you, to get this right, to produce our businesses into an asset, we do so by working with you to build your business into an asset of value. And I want to very quickly just talk through again how we do it in order to get the growth out, so that I can explain how Aurik Capital can support it through its funding. The first three layers that we do with you: what makes your business special in the eyes of your customer? We do positioning across the board, because if we argue that our product is great, or our skills are great, or our service is great, or our price is great, any competitor can argue the same thing, and if we are better than them, give them a bit of time and a bit of money, because they have to compete, out of necessity, they will be equally good with product or service or price. We've always argued that an asset of value needs to be built by understanding who your customers are, what problem they have, and the experience you give them and how you solve it. How do you market to them? How do you sell to them? How do you service them afterwards? And if they have a good experience and you become exceptional at selling into that group of customers, that informs how you build your business, which creates the next level, a system of delivery. Marketing, think about what marketing is. It's a bunch of activities that you put into an organized sequence with a measured outcome. If I'm going to do email marketing, I need a database. I need to have understood my database. I need to have understood the problem I solve for them. I need to have understood the experience they want. From positioning, we got that right. Then I'm going to create emails with pictures, with content on the email that I believe will help them see and understand their problem, the cost of their problem, and how we can solve their problem for them. The outcome is, if I send that to 1,000 potential clients on my database, I get 100 inquiries back. Activities in a sequence that can be measured. Importantly, that can be taught. Importantly, that can be delegated. Only delegatable because I've understood what the job of work is that I'm expecting my team member to do, and therefore I can measure the outcome. We do this with you across lead generation or marketing, sales or lead engagement, operations or fulfilling your promise, and money management. The gears that make the business work. The gears that make your positioning happen. And with that, you can now have a team made up of the right people doing the right thing at the right time. In an asset of value, building a purposeful, motivated team means giving your team control over the systems that they lead and empower and energize every day to present your business to the world through your positioning. Getting these elements right is crucial. And getting these elements right seldom requires funding other than debt-based funding that we can all get access to from banks. This gives you two outcomes. It gives you organic growth, and it gives you time. And I want to draw the picture that represents this. Think of it from this point of view. You've got your cogs, right? The cogs are the systems The systems are marketing, sales, operations, money management, procurement, administration. See them as the gears that once they're built and integrate and work together, they make the propeller turn. Without you in the middle of it all, I will have my team leaders for the cog called lead generation, marketing, and sales. My team leader for the cog called operations. My team leader for the cog called administration and fulfillment. And for so long as I built those cogs properly to empower them to turn the cogs, and then for so long as I've got the cogs working nicely together, it turns the propeller that gives you organic growth. Have a look at this graph. Over here we've got value, the vertical axis, and on the horizontal axis we've got time. And I'm going to draw out what organic growth looks like in a business. The black line, which is your revenue, can you see your business from year 1 to year 2 to year 3 is growing on an upward trend? It's not exciting growth, organic growth. It's a 6, 7, 8, 9, 10, 11, 12, 13, 14, 15% increase in your revenue year on year on year. Your costs remain equally steady. To the extent that your revenue increases, your costs increase. And the profit you make remains equally steady. So it's really important, folks, that we learn to understand our business in 3 numbers. 3 numbers, really. The economic units that give us a sense of our businesses. Our turnover or revenue, what is the year-on-year growth rate? Our operating overhead, our costs, what is the percent of turnover? Are you running at 60% of turnover? Are you running at 80% of turnover? And then our profit, what we would call EBITDA or profit before tax. What is that as a percentage of turnover? And profit before tax numbers change depending on what industry and sector you're in. But ideally, you want to be looking at least at somewhere between 16, 17% to around 35, 36%. It will vary from sector to sector and industry to industry. But what we're seeing over here is a business that is a nice business. It's a solid business. It's well positioned in the market. It's got a system of delivery that makes it all happen, empowered by a team of purposeful people. And a business like this is a business that should see you day to day involved in your business for 30% of your time. Managing your team, managing the outcomes, motivating the team, providing some support. But it shouldn't see you as the cause and creation and center of the business. Because working with us, and this is what we get right with you in the first 6 to 9 to 12 months. Thereafter, once your time is released from day-to-day activities, 70% of your time, we then move on to the next layers of the asset of value. And that's where we then start looking for accelerated growth. Where are the big next level growth opportunities that will increase your revenues and your profits? And once we have that in place, the last piece of work we do with you near the end is we focus then on deepening the value of your business, the profitability of the business. We focus then on ensuring that you have a business where your role is lessened and lessened and lessened, consistently putting you in a position to have time to focus on the next level of growth and thereafter the next level of growth. It's essential that because getting this architecture right in the design of your business will give you 3 outcomes. It gives you growth in revenue and size. It gives you increased profitability, and it gives you more time. If we're not leading our businesses, if we're not driving our businesses, if instead we are doing our businesses or being driven by our team and our suppliers and our customers, what we have created is a job for ourselves, not an asset. The picture of this business looks very different. Again, remember value and time. And what you'll notice over here, 1, 2, 3 periods, can you see that revenue was increasing, costs were kind of moderating, profitability began to increase. This is the transition from organic growth to next level growth. Because next level growth, when you get it right, will not upset your positioning in the market and create confusion for your clients and customers. It will not break down your system of delivery. In fact, it leverages and builds on the foundation of your system of delivery, and you will improve the performance of your team incrementally. It's not going to completely create chaos in how your team functions, operates, leads, and empowers that business. And finding effective next level growth strategies means that we need to find them in such a way that revenue, the black line, will increase at a far higher rate than the cost increases to support the performance of that revenue. And when you get that right, look what happens. The yawn, the distance, the gap between revenue and costs widens, and it comes through as growth in the profitability of a business. That is what an asset of value business does. And this is achieved by doing what you already do, but through designing and building the business to deliver this outcome. Okay, so let's talk about how we fund growth. Aurik Capital established itself in order to fund what the banks can't fund and never will fund and don't fund. We went to the public and we turned around and we said, we want to raise a fund for our clients. And they turned around and said, okay, we are happy for you to fund growth momentum. So not rescue, not turnaround, not survival, but growth momentum in a business. We want to fund businesses that have got organic growth organized and are looking for next level growth opportunities. And we can fund between 1 and 10 million rand into any business. And we do so by acquiring the equity. We do so by becoming a shareholder in your business, by buying shares. The money that's used to buy the shares is then invested in the business to deliver next level growth. Again, I need to stress that we are only permitted by our public mandate to fund growth momentum, not potential. So where do we find it? If you need to grow by increasing your plant, equipment, or stock, and we can see that you already are growing at maximum capacity, and what's holding you back is you don't have a big enough plant, you don't have enough equipment, you don't have enough stock on hand. And we can see the demand for your services and products outweighs your ability to service it. Because of this, we are permitted to fund that. We are permitted to fund the other assets, the intangible assets. People. If in growing your business, you need more people, you need talent, you need more skills, you need another engineer, you need a bigger sales team, you need administrative support, because that is sucking you back into the engine room, preventing you from doing the deals on next level growth. Software, acquiring software to improve the performance and efficiency of your business, so that with the system of delivery you built, you can carry a higher load of increased revenue growth. Software is expensive. We can fund that. We can fund marketing. If through your organic growth, what's holding you back is a lack of awareness of current or future clients and customers, and you've got campaigns that you have shown can work, but the campaigns need an investment to market and promote the business further into other parts of the country, into other parts of the world. People, software, marketing, banks never fund. Equity funding is the right answer for that. If you're moving into new markets and new customers, if you want to move from Cape Town to Joburg, Joburg to KZN, KZN to the Northern Cape, if you can see that what you're doing in your current province and location has value in other provinces and locations, or what you're doing in South Africa has value up north, or what you're doing in South Africa has value in the US, the UK, Europe, and you've identified and clearly articulated those opportunities, banks can't fund that. For that, you need a funding partner. We can fund all three of these elements that bring next level growth. When we fund, Aurik Capital acquires shares in your business. So Aurik Capital becomes a shareholder. And that's interesting. I don't know if any of you had an opportunity to listen to the Money Show last night. It was a conversation I had with Bruce around why it would be valuable to have an equity funder in a business. If you think about it, most of us, all of us, me included, no one is excluded. Most of us think about our businesses as operating entities. We know where to find the next deal. Mostly we know how to make it happen. Mostly we can all, over time, build businesses that generate good income. Mostly. It might be quicker for some and longer for others. The fact that we're working together will make it more organized and quicker. But seldom do we think about how we are going to realize the capital value of our assets to make our business wealth-generating assets for ourselves. Seldom do we think about the absolute harsh truth and reality that there are only two destinations for every business. It's either a sale for capital gain and value, or a closure. I've shared the stats in the United Kingdom, the United States, and Australia. The stats in South Africa are equally poor. And the reason in part is because we're not thinking about our businesses as an investor would. The moment you have an equity partner on board, besides the value they bring in terms of the investment to support your growth, the second big piece of value they bring is they think about your business differently. They think about your business much like you and I think about investing in a share on the stock exchange. They think about how your business can increase income growth because they want dividends. They think about your business about how it can increase its capital or equity value. And then they think about your business in terms of how it can be sold either back to you, to a third-party player in the market, a buyer, your management team, or the JSE. And the fact that they're thinking about your exit through their exit means immediately you've got both the right energies in the business. You and I, who focus predominantly on income growth, and they and them, who focus predominantly on the capital growth. Those two areas, if you recall, the formula for wealth, making money in our hands, growing the money in our hands, and then realizing the money, which is their core skill and expertise. It makes for a great partnership. The investment and return dynamics, we only offer this to clients in Aurik because we know you and we develop relationships with you. Growth, we understand your growth. We understand where the problems are. We understand where the opportunities are because we're working with you to resolve those. And performance, through monthly integration and through the dashboard and the data we collect there, we are able to support these funding applications. The exits I've spoken about. How does an equity partner, in other words, a shareholder, an investor shareholder, realize their exit? Because their job and our responsibility in Aurik Capital is to return the money to the people who gave it to us. In other words, our public investors. It's either through the sale of a business. You might decide, those of you who are looking to grow, deepen value and exit, should Aurik Capital invest in the business to support that process? Collectively, we would look at how to sell and exit that business 5 to 7 years from now. Those of you that are looking to scale, grow, and dominate your sector, not yet ready to exit your business, we would work with you to then raise debt at the appropriate time in order for you to acquire the shares back from Aurik Capital, so Aurik Capital can get its return and provide that return back to its investors. And you are then left with a business 4 or 5 times the size that can fund and finance that debt, but with 100% ownership back. Those are the exit options that really exist. The opportunity, obviously, is that we work with you to create a customized growth plan for your business. And then we look to fuel next level growth with you. You will notice that all of you have on your dashboard a fundability index. When the fundability index starts to move into positive territory, the opportunity to raise your hand and say, I'm looking for next level funding to support my next level growth presents. And what we do is we take you through a process called a funding bootcamp, where you value your business and prepare your business to pitch it to the Aurik Capital Investment Committee, which is made up of investors different to us folks in Aurik ourselves. From there, 5 to 7 years later, the exit is agreed. Either all of you, them and yourselves, exit the business through a sale, or you exit the investor in an organized, sensible fashion. And with that, I'm going to switch the presentation off, move back to full screen in order to have a good engagement around some questions, hopefully sensible answers. Any questions from anybody, anytime? On anything?
Pavlo, I'm going to ask.
Who's that?
It's Josh now.
Josh, now I can see you on my very, very large screen. Thank you.
Good. So obviously you need to be equitable for Aurik to purchase shares within your business. So how does that work? Because a lot of the times you've got to have sales to justify the buy-in, or how could you just explain a little bit more on that? Because I've had this conversation many times, and I just don't understand how that works. So for me, for example,
so let me answer that. If you think about it, an investor in the business, someone who's going to provide risk capital. So equity funding is risk capital. You have a business with 1,000 shares. You might have allocated 100 shares to yourself and you own 100% of the business, for example. When you provide risk capital means I'm going to have a discussion with you. I'm going to value your business today. And let's say your business is valued at R1 million. And let's say you want to raise 100,000 Rand of risk capital. Then I'm going to acquire 10% of your shares. So you will have 90 shares after the transaction, and I'll have 10 shares. And I then sit as a shareholder in your business. You take the 100 Rand that you've raised, the 100,000 Rand that you've raised on your million Rand valuation, and you're going to apply it to either purchase plant, equipment, people, establish a marketing campaign, whatever the case might be, that you and we, as the investors, are convinced will give you a growth outcome. So the business grows, and it grows over the 5 to 7 year period. And where it was valued in the initial stages of our relationship at R1 million, 5 years, 7 years down the line, the value of the business is now R2 million. Okay, think back to the share on the stock exchange. You bought it for R1,000, you sold it 5 years later, it was valued at R2,000. At a valuation of R2 million, if you say, hey, listen, fellow shareholders, investors, I want to sell my business, then those investors work with you to find Fatima. And Fatima looks at the business for R2 million, says, I like the business, I believe the business has got growth potential, I think it's well positioned, I think it will grow income, I think it will improve its capital value. I'm going to buy your business for R2 million, Joshna. And at that point in time, you own 90% of R2 million, which is 1.8 million Rand. And the shareholders, the investors, Aurik Capital, own 10% of the business, which they acquired 7 years before, and they extract from their 100,000 Rand investment, 200,000 Rand investment, and the business is sold. Alternatively, let's say you don't want to sell it at that point in time, but the investors want to get out because they have to return their investment back to their shareholders. Then they sit down with you and say, okay, Josh, now listen, we need to get out because we have an obligation to return our investment back to our shareholders. Let's do a valuation on the business. The business is valued at R2 million. We want to sell our shares back to you that we bought from you 7 years before for 100,000 Rand. We want to sell it back to you at the 200,000 Rand valuation. So we realize our capital gain. What we then do with you as Aurik is we're going to go to one of 4 banks where we have relationships, where we can demonstrate the growth path you've traveled, the growth future that you can enjoy. And because the asset is bigger and less risky, we raise debt funding from the bank of 200,000 Rand. And with that 200,000 Rand, you buy the shares back from Aurik Capital so they can give it back to their shareholders. You now own 100% of the business, and you settle that bank loan over a 2-3 year period. Does that make sense? Does everyone get that piece? Because that really is the formula behind funding. That's how it works. That's how it operates. In South Africa, we don't really understand how to use funding as a lever of growing our value and growing our businesses. In the US, typically, Stan, your business from startup to 20 years in would go for what they call an A series, a B series, a C series. It's 2, 3, 4 different rounds of funding where you look to bring the funding on board to grow from one level to the next level and thereafter to the next level and thereafter to the next level faster than you would otherwise if you only grew at an organic growth rate. In an organic growth rate, the business funds itself. In a next level environment, you need external funding to accelerate that growth. And it's a mindset, choice, and decision that you need to make as a business owner. The question you're asking over time is, do I want to own 100% of a business that will be valued at 10 million Rand 5 years from now, 7 years from now? Or do I want to own 70% of a business that would be valued at 20 million Rand 5 years from now, 7 years from now. And you can do the math and figure it out. 70% of 20 million, last time I remember, Mbato, in grade 12, when I sat writing my matriculant's exams, last time I remember, it was more than 100% of 10 million rand. And guys, that's the investor mindset working in your head. In your head, remember, you're a business owner, but you are the biggest single shareholder and investor in your own business. If you're going to buy a share on the Johannesburg Stock Exchange, you need to be thinking in the same way that we've had a discussion today around your own business. Does that help answer the question?
Yes, it does. I have another one. If no one else can, if no one else has a question, I'll just wait.
No, please go ahead. Please go ahead. We've got 15 minutes together, or 14 minutes left together.
Okay. So with me, for example, I've got a couple of products in my company that I know is scalable. So I wouldn't want to sell shares of my entire company, but possibly of that product. Is that something? No. It will be of the entire.
Yeah. So, okay. And I'll give you the reason why. In many ways, that product has no value unless it's marketed, sold, and serviced to your customers and clients. And in effect, what that means is that your business performs those roles. There is a product in itself is dead. It has no value. It's like an idea. An idea has no value. The thing that makes it happen, that executes on it, that implements it, that turns the idea or product into commercial value is the system of delivery and team. It is the function of a business. So investors always invest in the engine that turns an idea or product into commercial growth and value. Mbato.
Thank you, Pavlo, and good morning, everyone. I just wanted to know, other than the business that we've presented to Aurik, because obviously we as small business people, we often
stop there, please, guys. We're not small business people. None of us are small business people. As business owners, right?
Yes,
we are not. Let's get out of this government, excuse my French, shit of calling us SMEs. We are not SMEs. Every single person over here has the potential to build a meaningful business for value. We are not small business people. Sorry.
Okay, as I continue.
Please do.
As business people, we come across business opportunities where we are offered to buy shares into businesses, viable businesses. And the one that I'm particularly referring to is like a farming business where they export baby vegetables as well as herbs into the EU and the UK.
We won't fund that.
Okay, thanks.
We don't fund that. We have to fund the operating unit, the thing. So firstly, remember, we can only fund Aurik clients. The reason is because we know that the design of the business will emerge as an asset of value. And what funders are concerned about is that you can get involved in funding a business, investing in a business. The business can generate really good income. But if it can't be sold at the end of the day because it hasn't been built into an asset of value, that funder, in effect, never realizes their capital value. It's like a share that gives you a small dividend year on year on year, but when you want to sell it, you can't sell it because there's no one to buy it. So if it's a business that's doing well, that's exporting, et cetera, that you want to get involved with from a funding perspective, then what would be important is that Aurik has an engagement with that business And through the process of that engagement, we go through positioning the business effectively, building the system of delivery, ensuring that there's a team that can operate and run it, so the data on the dashboard can then come out to support evaluation and to support decisions around where next level growth would be. And most importantly, Abato, is to support the final exit and sale of that business to a larger entity. So that's the promise we made to the investors behind the fund. And that's why this fund is quite narrow. It's limited only to those to opportunities as I've shared with you.
What I wanted to find out,
Abram, yes.
What I wanted to find out, because yeah, the session was very interesting. Matlapeng fire and safety. Like I said, we are doing more fire and sales and stuff like that. But to grow the business, I don't know, like you said, now you don't fund for certain things. Because what we want to do is we want to be the company that does sales for other companies that's in line with us. Do you fund such businesses that want to buy more to import more stuff into South Africa and to become
okay? Guys, think about it. Think about, so Abram, your business model is similar to that of a wholesaler or distributor.
Yeah.
That's in effect what it is. Now, it's very, very hard to get into retail, for example, unless you work with distributors. It's very hard some of us are service providers to businesses who have very big clients. So for example, in the technology space, very often what you find is you are a provider of technology services to a bigger technology firm that then supplies a final service to a big bank. It's not unusual to be part of a value chain. If you look at the automotive industry, you've got a BMW. BMW only has 100 suppliers. They're called tier 1 suppliers. The tier 1 suppliers each have 100 suppliers. They're called tier 2 suppliers. The tier 2 suppliers each have 100 suppliers, called tier 3, and then it goes down to tier 4 and tier 5. So if you're part of a process that gets a product or service to the final client, but you're not selling to the final client, that is a completely valid business model. And that business model, if it's built right, is extremely profitable.
Pavlo, just a question, Mr. 1, 2, 3, Randall Peterson.
So guys, listen to me, Randall, can I stop you there?
Yes.
So you would have noticed, I mean, I've already shouted at Mbato for calling us, or herself, because the way you think about yourself is the way you present yourself to the world.
Yes.
So I just want to share one thing. Have a look at what does my name say?
Pavlo Phitidis.
Yeah, and?
Pavlo at aurik.com, what did I see it?
This is a piece of real estate. Your screen, your Zoom name is real estate. You're meeting with people. Yes. You're meeting with clients. You're meeting with suppliers. You're meeting with potential employees. You should be marketing your business 24/7, all the while, all the time.
Okay.
Okay, important, eh? It's really, really important. So the way that you have a background organized, the way that you write your name on that screen, make it and use it as a marketing opportunity. Because, for example, over here, Tumi's going to land up asking me a question, right? And Angela's going to sit there and say, geez, that was a really interesting question. I understand what Tumi's business does. I know I can do business with Tumi. We finish the call, she doesn't know where to find Tumi. But if Tumi had over there, Tumi at, let me see, Timo Process.
Yes.
.co.za. Man, before you know it, So guys, let's use everything to our advantage. Everything to our advantage. Sorry, your question, Randall.
Okay, right. The business name is Beyond Risk Projects. We are a building maintenance company. But the question that I want to ask you is that our relationship with Aurik now, is there any limit to funding? I mean, is there next 5 years or whatever? As we go, grow our business?
Yes. Okay, all right. So this fund is called a Section 12J fund. And government put rules and regulations around Section 12J funds. Section 12J funds were designed to support the funding. I'm going to use government language, Mbato, so please don't get cross with me. Okay, government language. You know the patronizing language they use towards us? The SME economy is so important. The SME this, the SME that. And yet they never turn talk into any real walk to create an environment for growing businesses to thrive. It really makes me furious. In any event, government put together the Section 12J tax directive to support the funding of SMEs through equity. And they put rules and regulations around it. And one of the rules and regulations is that you have to be invested in a business for a minimum period of time. So we would have to be invested for a minimum period of time. The argument is a sound argument. Intellectually, it's a sound argument, because when you put equity investment in a business, accelerated growth takes longer than just organic growth. So you need to remain invested if it's genuinely intended to support growing businesses for a longer period of time, typically, than a shorter period of time. The reason government did that, Randall, is because they said anyone who invests, the funders of the Section 12J fund, we're going to give you a tax break. So we're going to give up our taxes that we collect from you on the basis that you're going to put it into a Section 12J fund like Aurik Capital, because we believe that if that's properly invested, it will support the growth of SMEs in South Africa. So the theoretical, intellectual structure behind that is solid and sound, and we have to comply with those rules and regulations. Otherwise, we wouldn't have the fund made available to us.
Okay. Thanks.
Pavlo, can I ask a question?
Hello. Oh,
Who was that?
Bulelwa.
Sorry. Oh, here you are. I can see it on my screen. Bulelwa, yes.
Yes. Good morning, everyone.
Good morning.
I wanted to find out, because I'm into construction, and my ultimate goal is to buy land and develop it. So I wanted to find out.
We won't fund property. We don't fund property.
Okay.
Remember, what we fund is the business that makes what you do happen. So there are certain restrictions with the fund. We can't fund, for example, an accountancy firm. We can't fund an insurance firm. We can't fund fixed property. We can't fund makers of guns, even though it's a really good business right around the world. We can't fund cigarettes, but we can fund cannabis.
Oh, that's weird.
If anyone can explain that to me, then that it's not a fight I'm going to have with government. They made these rules and regulations based on some weird argument. That's what we can fund. That's what we can't fund. So we can't fund property, unfortunately. I'm aware that we have 1 minute left. I promised that I would not take more time than I would otherwise. Pinky,
Pavlo,
you do have a
ask a
question. Please go ahead.
Thank you. It's Martha, and how are you this morning?
Well, and you, Martha, whose name is also Pinky.
Thank you. Earlier on, you spoke about strategies relating to skills, grow, and dominate. And
Yes.
you also mentioned exit and
Yes.
business deepening. Now, my question is, how can I identify threats and opportunities that can lead to better planning and strategy, because one doesn't want to see herself
That's
being
exactly what
bankrupt
we're
in the
doing with
future.
you. Guys, let me explain something. The work we do with you will solve all these issues for you, 100% guaranteed, but only on one condition. And the condition is, what we do with you is not advice, it's not consulting, it's not training. If you think about every session we have with you, we are building businesses with our hands. They're activities. And Pinky, I'm going to answer your question as the last question. I've been doing martial arts, Kung Fu, for 30 years. I started in my late teens. You know how I learned? In 8 months, I learned my entire system. There are 109 moves, strikes and blocks that make up my system of Kung Fu. In 8 months, I knew every single move. And it was useless, because when I fought, I used to get beaten up. But I knew every move. The way that I made it valuable was through practice. Practice is the art of implementing everything you're given. Because if we, for example, work with you on an activity to generate leads, in other words, market your business, to the extent, oh, that's fantastic. Joshna, we should have a sparring session. To the extent that you implement it, so look at the customer surveys we do with you, for example. Eric goes and he does it with one customer, right? Tumi does it with 20 customers. Who's going to get the better outcome?
The one with 20.
20. You know why? Truth is only ever found in action. And when you implement what we work with you on, it makes it your own. It gives you your own insights. That's what develops the intellectual property. That's when you can see. So email marketing doesn't work. Instead, eventing works for me. And that's how you set yourself apart and sort out the gear called marketing. Because once that's working, we move to the next gear called sales. And it takes time to learn how to sell across a screen. It takes time to learn how to make a presentation when you're selling, how to write proposals when you're selling. And it's only after you do it again and again and again and again and again, excuse me, do you then see what works, what doesn't work. And then Stan, what do? You do more of what works.
Yes.
And when you figure out what works, Martha, you very quickly understand that what works is a process that's made up of 1, 2, 3 activities put in order that give a measured outcome. And that gives me the opportunity to then say to Tanya, who's working in my business, Tanya, I want to capacitate you to lead this process. These 3 activities, do them every month, and we should get 5 new inquiries every month on the back of them. That's how we find our path. Anyone who says they know the answer to your business, anyone who says, Wanga, I know better than you what you need to do and where you need to go. In any instance like that, where you outsource responsibility for the growth and advancement of your own business, beware of white knights, false prophets, and silver bullets. They don't exist. Guys, I hope that was helpful and useful. There'll be an email going out to everybody after this on Aurik Capital, more on Aurik Capital. And through that, we are open for engagement and discussion further. So thank you all very much for giving up time to be here. I really do hope you got value from the session. You got a deeper understanding of Aurik Capital, and that you keep it in your back pocket for when you're ready to get to that next level.
Thank you. Thank you.
Thanks, Pavlo.
Go out there and make it happen.
Thank you.
Nice.
Thank
All the
you.
best.
Thank you.
Bye-bye.
Bye-bye, everyone.
Bye.
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 Bye-bye.
Bye-bye.